All right, class. So this week we are going to be talking about capital budgeting. So this chapter 10 is about capital budgeting techniques. And with that, we will get right into it. So with this chapter, we are going to understand the key elements of capital budgeting process and how to calculate, interpret, and evaluate the payback period, as well as calculating, interpreting, and evaluating that net present value, the NPV, and the economic value added, the EVA. We're also going to look at the internal rate of return, IRR, and using those net present value profiles to compare the NPV and those IRR techniques. And then we're going to look at those terms and conflicting rankings and the strength of each of those approaches. So with that, let's start with the overview. So capital budgeting is the process of evaluating and selecting long-term investments that are worth more than they cost and create wealth for our investors. Capital expenditure is an outlay of funds that produces benefits over several years. So with this capital budgeting process, we're going to consist of 5 distinct but interrelated steps, right? So they meld together. The proposal generation, the review and analysis, the decision making, the implementation, and then following up. So with proposal generation, we are looking at our managers at all levels who are making proposals for our new investment projects. Then they, in turn, are going to send them to the financial managers who are going to perform a formal review and analysis to assess those merits of those proposals that were suggested. The proposals that require large outlays, they receive greater scrutiny than those less costly ones, right? Then we are in decision making. So we're going to delegate our capital expenditure decisions based on the basis of dollar limits. Generally, our board of directors or a team of our senior execs, they have to authorize those expenditures beyond a certain amount. Mid-level managers, they might authorize more routine investments that require those smaller cash outlays. Then we look at implementation. So following that approval, we have to make those expenditures and implement our projects. Expenditures for a large project most often occur in phases. And then we're going to follow up. So we're going to have those results monitored and we're going to compare our actual costs and benefits to the projections that were originally used to justify that that investment actually made sense to us. Managers might take actions to expand, contract, or maybe even shut down investments when those actual outcomes are different from those projected ones. So here's some more terminology. Independent projects. Those are cash flows who are unrelated to or independent of one another. Accepting or rejecting one project doesn't change the desirability of another. Mutually exclusive. Those compete with one another so that the acceptance of one eliminates from further consideration all other projects that have that similar function. Unlimited funds. Those are where a firm has those sufficient internal funds or they can raise external funds to pay for all of the attractive investment opportunities. And capital rationing is where the firm has a fixed investment budget and numerous projects compete for those specific dollars. The accept reject decision. This is evaluation of capital expenditure proposals to determine whether that firm is going to meet that minimum acceptance criterion. Ranking approach, the ranking of capital expenditure projects on the basis of some predetermined measure, like how much value that project creates for our shareholders. Then we're going to look at techniques, right? These ensure that the investment projects that the firms are pursuing have that best chance to create wealth for our shareholders. So managers are going to need tools to help them evaluate those merits of those projects and to rank compete investments. A number of techniques are available for performing those analysis, and the best techniques evaluate projects based on timing and the risk of cash flows that they will generate. Project evaluation methods that fail to account for money's time value or for the risk might lead to suboptimal investment decisions, either by directing managers to make those value destroying investments or maybe discouraging them from creating those value creating projects. So with that, we look at Bennett Company's project cash flows. We're going to use one problem to illustrate several budgeting methods throughout this chapter. The problem concerns that Bennett Company, which is a medium-sized metal fabricator, is that they're currently contemplating 2 projects that require cash outlays upfront to generate cash inflow years later. So project A requires an initial investment of 420,000, and project B requires a little bit more at 450,000. So we're going to look at the projected cash flows for the two projects. So here are the expenditure capital for project A and B and the cash inflows in years 1 through 5. So you can see that project A is bringing in 140,000 and project B starts off with 280 and then it goes down to 120 and then the following 3 years is at 100. So let's take a look at that in our timeline sense. So this is where we're going to use the future outflows to generate that net present value of what that costs today, right? So we're going to be using the discounting term. With that, we look at the payback period. This is the time it takes that investment to generate cash inflows sufficient enough to recoup that initial outlay required to make the investment. So we have some decision criteria. So if the payback period is less than that maximum acceptance payback period, we're going to accept a project. If that payback period is greater than that max payback period, we're going to reject it. So again, Bennett Company, projects A and B. So project A is an annuity. The payback period is 3 years, right? If we take a look at our payback period here, it costs us 420. So if we see that, we divide the 140 that comes in by that 420 and we get 3. But B has that mixed stream that we talked about before, right? Because it's not as clear. So in year 1, that firm's going to recover 280,000 of the 450. By the end of year 2, they're going to have recovered 400,000. That's the 280 plus the 120. At the end of year 3, 500,000 will have been recovered, but only 50% of the year 3 cash flow of 100,000 is needed to complete that payback of 450. So the payback period for project B is 2.5 years. So that's 2 years plus 50% of year 3 makes that a half a year. So if their max acceptable payback period were 2.75 years, we're going to reject A and accept B. If the max acceptable payback period was 2.25 years, we're going to reject both of those projects. If they ranked projects, B would rank above A because it has a shorter payback period. No matter what payback period that the company's going to require, it's not clear from that analysis which investment will do the most to increase our shareholder wealth, right? Because that's ultimately why we're in business. We want to create wealth for our shareholders. All we can say based off of this information right now is that Project B recoups that initial investment more rapidly than Project A does. A 2017 survey of firms in India found that 2/3 of those firms always or almost always conducted that payback analysis when they made major investment decisions. Similar to results found in the US, a lot of small companies in India were more than likely to use that payback approach. But for all its flaws, the payback approach still seems widespread around the world. So here are some pros and cons. So large firms are going to use that payback approach to evaluate small projects, or maybe they're one of several metrics that they use to judge a larger project's merit. And small firms are going to use it to evaluate most of their projects. The payback method's popularity results from its simplicity and that intuitive appeal. And by measuring how quickly the firm's recovering that initial investment, the payback period also gives at least some consideration to the timing of cash flows. Likewise, it also offers a crude way to adjust for project risk if managers require a faster payback on riskier endeavors. The main weakness of this analysis is that the threshold is subjective and has no solid connection to the value creation. So here's a personal finance example. Gabriela Perez is considering investing $20,000 to obtain a 5% interest on a rental property. Her good friend and real estate agent, Josh Williams, put the deal together, and he estimates that Gabriela should receive between $4,000 and $6,000 per year in cash from that 5% interest in the property. She expects to remain in the 24% federal income tax bracket for a while, and she will not make an investment unless the after-tax cash flows pay back the initial cost in fewer than 7 years. So let's take a look at her payback period on this deal. If the pre-tax cash flow is $4,000, her after-tax cash flow is going to be $3,040. So 4,000 times 1 minus her tax rate. If the pre-tax cash flow is 6,000, her after-tax cash flow is 4560. Again, 6,000 times 1 minus her tax rate. So dividing that initial investment by those after-tax cash flows gives two estimates of her payback period, right? So for the first one, that 30,000, 3040, so 3,040, that payback period, if we take that 20,000 of initial investment divided by 3040, we get 6.6 years. So that's under that 7-year threshold max that she wants. If the after-tax cash flow is 4560, her payback period is only going to be 4.4 years. So either way, that investment pays back that initial cost in fewer than the 7 years that she wants, and it's acceptable to her. Which one would be the better option if she wants it done faster and she gets her money back faster? Hopefully, if she makes more money, gets that $6,000 from the rental property, she can go with the second option there in the 4.4 years. The payback approach suffers from a second weakness as well. Those calculations fail to fully account for that time value of money. Remember, we haven't done any discounting to see what that NPV value is for any of those numbers on our timelines, right? We were just going off of that basis amount. Let's take a look at another example. DeYarman Enterprises, a small medical appliance manufacturer, is analyzing mutually exclusive projects named gold and silver. The firm uses payback period to choose their projects, and it requires any investment to recover their initial cost within 4 years. The cash flows and payback period are going to be in this next table here. So Project Gold, 50,000 cash inflows. The first 2 years are 5,000. Year 3 is 40. Year 4 and 5 are 10,000 apiece. So payback period for Project Gold is 3 years. Project Silver, 40,000 the first year, 2,000 the second year, 8,000 the third year, and 10,000 after that. So again, that one is also a 3-year acceptance. So again, we're looking to recover that cost within 4 years, right? So both of those are acceptable. Comparing the cash flow reveals that silver produces more cash flow sooner than gold. In year 1, silver is going to generate 40,000 compared to that 5,000 for gold. We know that because money has time value, it's preferable to receive that cash flow sooner rather than later, right? So the payback approach fails to recognize that benefit. Any capital budgeting tool that properly accounts for that time value money would rightly favor silver over gold. A third weakness of the payback period is that it ignores the cash flows beyond that payback period. So it's going to understate the true value of investments that deliver cash in the more distant future as well. Here's another example. Rashid Company, a software developer, has 2 investment opportunities, X and Y. We're going to take a look at this table. So X and Y, we have 10,000 in cash outflows, right? And our cash inflows, year 1 for X is 5,000, year 1 for Y is 3,000. Year 2 is 5,000, year 2 for Y is 4,000. So in Project X, we have a payback period of 2 years already, right? We've paid back our money. We've gotten our money back. Years 3 was 100 and 4 and 5 was, 1,000 for 3 and 100 for 4 and 5 for Project X. Project Y, we have another 3,000 coming in. So now we're paid back in year 3, okay, for that Project Y's investment. Years 4 was 4,000 and year 5 was 3,000. So it took us a little bit longer to pay back Project Y, but we're also getting a little bit more money, right? Because we have extra flow of cash here. So strict adherence to the payback approach suggests that X is actually preferable to Project Y, but it only provides an additional 1,200 cash flow when it pays back the initial cost, whereas Y produces that extra 7,000 after that 3-year payback period. So unless this company faces a high cost of capital, which means that the value of the distant cash flows from Y is very low, Y actually is preferable than X, right? The payback approach ignores those cash inflows occurring after the end of that payback period. We can look at a discounted payback. One way to improve the payback approach is to calculate the payback period using that discounted rather than undiscounted cash flows. It's the time required for an investment to generate their discount cash flows sufficient to recoup that initial cost. So as with ordinary payback analysis, the discounted payback places no value on cash flows that arrive after the firm's maximum acceptable payback horizon. So let's take a look at Bennett Company again. Suppose their cost of capital is 10%. It wants to know the discounted payback period. So let's take a look at that analysis. So again, we're going to see the discounted cash flow. Again, that's our net present value of that money now, okay? So we can see that the discounted payback for project A is actually 3.8 years, and project B is 3.3 years compared to their payback without using that discounted cash flow, right? So we would normally look 3 years. It's actually in today's value, it's going to cost us 3.8 years in today's dollars. Project B, we would pay that back in 2.5 years. The discounted payback today, it's going to cost us with today's dollars 3.3 years to get that money back. So B is still providing us with a faster turnaround to get our money back, right? So we looked at that. So in that first 3 years, again, that generated that discounted cash flow for project A of 348,159. So it takes another 71,841 of discounted cash flow in year 4 to reach that 420. So if we look at the cash flow in year 4 for project A, it's 95,622. So if we take the 71,841 and divide it by the 95,622, we get 8/10 of the cash flow, which is why it was 3.8 years to earn back that 420,000. So that comes out to 3.8 years. With project B, they're earning 428,850 in the first 3 years. So again, we need to reach that 450. So we're going to require an extra 21,150 or 3/10 from year 4. So the discount payback for B is 3.3. So if the max acceptable payback period is 2.75, we're actually going to just reject both of these using the discounted payback period. Project B would rank above Project A because of that shorter discount payback period. The discounted payback method makes at least some adjustment for that time value of money, but otherwise it shares that same pros and cons of the conventional payback approach. Now let's get into NPV, right? Our net present value. It's a technique that measures the investment's value by calculating the present value of the cash inflows and outflows. So our NPV is equal to the present value of cash inflows minus our initial investment. Not every investment opportunity has this kind of standard cash flow pattern. Sometimes the firms are going to receive money up front and have to pay out cash in later years. Other times, a project's going to require several years of cash outflows before those inflows begin. So we have equation 10.1a is a more general equation for an investment's NPV. In practice, some firms apply the same discount rate to every investment project. And when that's the case, they're going to use their weighted average cost of capital, their WACC, as the discount rate, R, in equations 10.1 and 10.1a that we looked at. Researchers conducted a survey of 125 CFOs and found that 97% of firms uses a discounted cash flow method like NPV to evaluate their investment proposals, and the average discount rate they used was about 15%. That was puzzling because at the time of the survey, a lot of companies faced much lower financing costs. Those studies authors independently calculated a WACC for each firm that responded to their survey, and they found that firms were setting discount rates that were roughly double their true cost of capital. Setting discount rates too high will make investment opportunities look less attractive. And the study concluded that the firms who are most likely to set excessively high rates faced operational constraints like limited managerial bandwidth. So for these firms, setting that discount rate high acted as a screening device that weeded out all but the most attractive investment projects. So we have some decisive criteria for our NPV, right? If the NPV is greater than 0, we want to accept the project. If it's less than 0, we want to reject the project. If it's greater than 0, the firm's going to earn a greater return than that cost of capital. The investment's cash flows exceed outflows on a present value basis. So our firm's market value will increase by an amount equal to that NPV. So let's take a look at the example for Bennett Company again, for projects A and B. So they had a 10% cost of capital to discount the cash flows. So let's take a look at their NPV, right? So NPV is equal to negative 420, right? That's our cash outflow for A. And we get a return every year for 140,000. So that's our top number. We're going to divide that by 1 plus 0.1. That's their cost of capital to discount, right? And then that's going to be the exponent there is going to be the year for that, okay? NPVB, again, this one is costing us 450,000. That's why it's a negative 450. The cash outflow corresponds to that year in the exponent, right? Of 120,000. So we can see that the net present value for project A is $110,710. And for project B, it's $109,244. So we're going to look at a figure that depicts the cash flows and NPVs. They both have positive NPVs, so they're both acceptable, but A is actually more valuable than B now. It has a higher NPV, which creates more value for our investors. So if we could only pursue one investment, we really should choose A, okay? Because that NPV in today's dollars is going to be $110,000, a little bit over that. Where project B, while it recouped money, a little bit faster, it's still in today's dollars only worth 109 and some change. So A is actually more valuable than B is. We can use our calculator to figure out what that payment would be by plugging in the CFO is a negative 420. Year one's is 140. The frequency of cash inflow is 5. And then after you enter the discount rate of 10, you're going to compute that NPV, right? Same thing for project B here, except it's not going to be the same every time, right? We have different cash flows that are coming in. So 280, 120, 100, and then that frequency of the 100 would be 3. So then you calculate the NPV here. Again, you're going to get the same figures. We can also use the Excel spreadsheet by using the equals NPV function. Again, you get the same figures for A and B. So there's a variation of the NPV rule, right? For a project that has an initial cash outflow followed by cash inflows, there's a profitability index, a PI. It's simply equal to that present value of cash flows divided by the absolute value of the initial cash outflow. So we're not going to have a negative number here because this is just the initial cash outflow. A PI greater than 1 is going to imply that the present value of the cash inflows is greater than the absolute value of the initial cash outflow. So a PI is greater than 1 corresponds to that positive net present value. So NPV and PI methods will always come to that same conclusion, whether an investment is worth doing or not. Here's an example. This is again for Bennett. We're dividing present values by each investment's cost to give us a profitability index. So we can see that A is more profitable than B. A has a profitability index of 1.26, where B is 1.24. Both are acceptable. They both are over 1, which shouldn't be surprising because they both have positive NPVs, right? But again, A is preferred over project B. It's not always true that the NPV and PI methods will rank projects in exactly the same order. Different rankings can occur when different projects require initial outlays that have different magnitudes. We could also look at economic value added, or EVA. It's a registered trademark of the consulting firm Stern, Stewart and Co. It's another close cousin of NPV. Whereas the NPV approach calculates the value of an investment over its entire life, the EVA is going to give managers a tool to look at a year-by-year basis as well as over the entire life. It begins the same way that the NPV does, by calculating that project's net cash flows. But the EVA subtracts from those cash flows a charge that's designed to capture that return that the investors are going to demand on a project, right? So the EVA is equal to no PAT minus that EVA charge, where the no PAT is going to equal OCF minus depreciation, or outflow cash, right? Outflow cash flow, and minus invested capital times that cost of capital, right? That's our EVA charge. By subtracting the capital charge from each year's no PAT, the EVA calculation asks whether that project's going to be positive cash flows above and beyond what the investors are going to demand. To calculate the EVA, we want to discount that figure by using the firm's cost of capital. If that figure is positive, the project generates a positive EVA and it's worth undertaking. It determines whether a project earns that pure economic profit, which is a profit above and beyond our normal competitive rate of return on a line of business. So we're going to look at Bennett Company again, and we're going to use this company to calculate the annual EVA and project EVA, right? To find the annual NOPAT and invested capital, we have to make an assumption about how the initial investment for each project depreciates over time. So here is our table here. So we have our cash flow for A, our depreciation, and our NOPAT is at 140 minus 84 for every year. The beginning of capital, beginning of year invested capital, that'd be the 42, 420,000 minus the 84, which is the depreciation, times 0. So we're not depreciating anything really this year. So our beginning of year invested capital is still at 420. At the end of year 1 and going into year 2, we're looking at 420 minus that 84,000 of depreciation times the first year. So we really are looking at subtracting out that 336,000 and so on and so forth. Here is B. So sorry, this is still A. The EVA charge, I didn't realize it was split up like this. The EVA charge, again, is that 10%, that discount rate, right? So they're going to take what our beginning of year invested capital is and multiply it by that EVA charge. And then what you're going to do is get your annual EVA, which was the 56, the NOPAT, right? Minus our EVA charge to get what our annual EVA is. And then the present value of those annual EVAs. So again, taking the annual EVA and dividing that by 1 times the discount rate to that year that we're in for the time to get that present value of that annual EVA. So our sum is to find the project EVAs for A is 110, 710. Again, B is set up the same exact way. And the sum for B is the 109, 244. So because those projects last 5 years, assume that the assets purchased with the initial investments lose a fifth of their value through depreciation every year, right? So it's an equal amount of depreciation every year. So how do we calculate that depreciation? With A, you're doing 420 divided by 5 years, getting that 84. And the NOPAT's that 140 minus 84 to get the 56. The AVA charge is based on the invested capital at the start of each year, which equals the initial investment less that depreciation, right? So like I said, in year 1, we don't have any depreciation because we just invested that. So it starts in year 2. So with that, we are basically just looking at what we looked at in the tables. So the capital charge in the second year for A is 336. With each passing year, an additional 84,000 is subtracted during the final year. Only 84,000 remains invested in project A. So to calculate the EVA charge, we're going to multiply our invested capital at the start of the year times that 10% cost of capital for the company. As the amount of invested capital decreases over the life of the project, the EVA charge is also going to decrease. Each year, the EVA cash flows equal the NOPAT less the EVA capital charge. So project A generates pure economic profit every year. Repeating those calculations for project B reveals that only during the first and last years does the project actually generate enough net profit to cover the annual investment charge. So that for 2 years, for years 2 through 4, the project's actually generating an economic loss. However, before rejecting project B, let's consider the project EVAs. And I'll go back to B here. So you can see here, this is B. So again, that year 1, we're at 131, year 2, negative 49, year 3, negative 12, year 4, negative 5, right? So to find those project EVAs for B, we're going to discount again by that 10%. The NPV and the EVA methods reach that same conclusion. They're acceptable because they create 110, 7 for A, and 109, 2 for B, right? They create that value for their shareholders. Here's another example. Suppose an investment in land which never depreciates costs $1 million up front, but after that, it's going to generate net cash inflows each year of 120,000. To calculate the NPV of the project, we're going to discount the cash flows and add them up. So the cost of capital is 10%. So let's do the negative 1 million, right? Cash outflows plus the 120 divided by the 10%. So we're going to get 200,000 as our NPV. Let's calculate the EVA in any particular year. Start with the annual 120,000 cash flow, assign a charge. So in this case, the firm's going to invest that 1 million. Investors are going to expect a 10% return. So our annual capital charge is going to be that million times the 10%, right? So 100,000. And the EVA is going to be 20,000. So we're taking the 120 minus the 100 to find our EVA of 20,000 every year. So in other words, the project's going to earn 20,000 more than its cost of capital every year. So it's obviously worth doing, right? We have a positive EVA. To calculate the EVA over the entire life, we're just going to discount the annual EVA using the firm's cost of capital. So what we're going to do here is we're going to take that 20,000 of EVA divided by that 10%, and we see that it gives us a project EVA of 200,000, identical to our NPV. Now let's look at the IRR, our internal rate of return. This discount rate equates the NPV of an investment opportunity with $0 because that present value of cash inflows equals that initial investment. It's the rate of return that a firm's going to earn if it invests in the project and receives the projected cash inflows, right? Recognizing that projects might have cash inflows or outflows at any time period, including period 0, we can define the IRR more generally as this equation here in 10.4a. So you'll notice that it is the sum, so you might have multiple cash flow years. So cash flow, the time, divided by 1 plus that IRR, which is that rate of return. We have some decision criteria, right? So if the IRR is greater than the cost of capital, we want this project. If it's less than the cost of capital, we're going to reject the project. We don't want it. Managers pursue only the investments that they expect to earn a rate of return that meets or exceeds the firm's required rate of return. Investing in those projects should increase the firm's market value. So let's look at Bennett again. We're going to find the IRR for projects A and B by finding a discount rate that equates that present value of each investment's cash flows to that initial outflow. So again, remember, this is our discounts. Here's our timeline. And again, there are calculator ways to do this as well as Excel sheets to do this. But they did this here quickly. The IRR of A is 19.9 and the IRR of B is 21.7. So both projects are acceptable because they provide that greater return than that 10% of cost of capital, right? So let's figure out how they came up with those IRRs. So project A, we are going to solve. Remember, 0 equals, and it is the sum, remember? So our negative cash outflow of 420 plus our inflows, 140 over our IRR. So we're going to solve for IRR now, right? Same thing for B. We have our negative 450, our 280 in the first year, second year, third year, fourth year, so on. So we're going to either use a trial and error approach, a financial calculator, or a spreadsheet, like I said. Project A has a large NPV when the cash flows are discounted at 10%, which implies that the IRR has to be greater than that 10%. Let's try 15%. That's going to give us an NPV of 49,302. The NPV is greater than 0. The IRR still has to be higher than that, right? Because we want it equal to 0. Same thing, just through trial and error, you can figure it out, 19.9%. Same thing with B to find 21.7. But we can also use our calculators, right? So we're going to find the IRR. So in the programmed functional calculator, if you have one, you can use this. So rather than entering a value for the interest rate and computing the NPV, we're going to enter the cash flows and push compute an IRR, okay? So it shows you both A and B here. And then you can also use the Excel sheet, again, using the IRR function. So equals IRR, and then you will put in the outflow plus all the inflows. It's really simple on Excel. I really love how Excel has all these already built into it. So here's a personal finance example. Lorenzo Flores is evaluating an investment opportunity that costs $7,500. He expects to receive annual cash flows of $500 a year for each of the first 4 years, followed by $700 per year at the end of years 5 through 8. He plans to sell at the end of year 8 and net $9,000. His investment risk, he wants to earn at least 9% return. So let's calculate his IRR. So here's a summary of his cash flows. So again, he had that initial investment, 75, the 500 from years 1 through 4, 5 through 8. He was looking at 700, and then selling at the end of 8, a net of 9,000. So that totals 9,700 in 8. So let's substitute cash flows, into a calculator or a spreadsheet. You're going to find that the IRR is 9.54. So that exceeds his 9% return that he wants, right? So he's going to choose to make this investment. We can compare the NPV and the IR techniques now. Okay, so net present value profiles, it's a graph that depicts our project's NPVs calculated at different discount rates. Let's look at an example. To prepare net present values for Bennett again, we're going to calculate the NPV using a few different discount rates. Then we're going to plot those on a graph. So we're going to see that example 10.6 earlier today. We looked at a 10% discount rate. The NPVs of project A and B were 110, 710, and 109, 244. 1010 showed that project A's NPV was 0 at a discount rate of 19.9 and B's was 0 at 21.7. So for a third data point, let the discount rate be 0, which means the NPV is just going to be the sum of the cash flows over time, right? So A is going to be 280, B is going to be 250. So let's look at this table here. Here are our NPVs and the discount rates associated to them. And here's our graph that we can look at with all the different points for the discount rate and what that NPV looks like for each of those projects. It's easy to generate more coordinates by simply calculating the NPV for each project at other discount rates. And you can plot those on the curve. For project A was the blue and B was the red. It also reveals 3 important facts. The IRR of project B is greater than that of project A, so managers who use this method of IRR are going to rank B over A. The NPV of A is sometimes higher and sometimes lower than that of B, depending on what that discount rate is. So the NPV method will not consistently rank A above B or vice versa. It's going to depend on that cost of capital. When the cost of capital is approximately 10.7%, they both have identical NPVs, as you can see here on this graph where they intersect. The cost of capital is 10%. At that rate, project A has a higher NPV than project B, the blue line above the red line. So the NPV and the IRR methods rank the two projects differently, okay? If the cost of capital were a little higher, like 12%, the NPV method would rank B over A, and there wouldn't be a conflict in those rankings. Conflicts in the rankings given a project by NPV and IRR resulting from differences in the timing and the magnitude of cash flows. So that can happen. So let's talk about that timing of the cash flow, right? It's different between the two projects. The IRR and the NPV methods, they may rank the projects differently. We saw that it shows that the upfront investment required by each project is similar. After that, the timing is quite different for those cash flows. Because so much of project B's cash flows arrive early in their life compared to A, the NPV of project B will not be particularly sensitive to changes in that discount rate. Project A's NPV will fluctuate more as that discount rate changes, though. Because project A's cash flows arrive later than project B's, when that firm's cost of capital is relatively low, the NPV method is going to rank A over B, right? At a higher cost of capital, the early arrival of B's cash flows become more advantageous for our firm, and the NPV method is going to rank B over A. So difference in the timing of cash flows between the two methods, they don't affect the ranking provided by the IRR method, though, right? Well, that always is going to put B ahead of A. It's got a higher IRR. So again, here's a table that shows the IRR method selecting project B always. If the NPV, if that rate is less than 10.7%, project A is the clear winner. If it's higher than that, it's project B. We could look at the magnitude of the initial investment as well. So suppose someone offered you the following two investments. You're going to invest either $2 today and receive $3 tomorrow, or you can invest $1,000 today and receive $1,100 tomorrow. The first investment IRR there is 50% in one day, a return that surely would surpass any reasonable hurdle rate, right? But after making this investment, you're only better off by $1. On the other hand, the second choice offers a return of 10% in a single day. It's far less than the first opportunity, but earning that 10% in a single day is still a very high return. In addition, if you accept that investment, you'll be $100 better off tomorrow than you were today. Most people would choose the second option, even though the rate of return on that option is far less than the rate offered by the first option. So the scale or the magnitude problem occurs when two projects are very different in terms of how much money is required to invest in each project, right? In these cases, the IRR and NPV methods may rank the projects differently. The IRR approach and the PI method that we talked about earlier, they might favor small projects with high returns. The NPV approach favors the investment that makes the investor the most money, though. It's important to watch for those conflicts in project rankings provided by those NPV and IRR methods, but differences in magnitude and timing of cash inflows don't necessarily guarantee conflicts, okay? In general, the greater the difference between the magnitude and the timing of the cash inflows, the greater the likelihood of the conflicting rankings. So when a conflict in rankings does occur, the project with the higher NPV is going to create more wealth for investors, right? Other problems with IRR. We can interpret the IRR. It could be tricky. It doesn't match our conventional form of outflows followed by inflows. We can look at borrowing versus lending. So we can modify our IRR decision. So if we have cash outflows up front, followed only by cash inflows, except investments that have that IRR greater than our cost of capital. But if we have investments that cash inflows up front, followed only by cash outflows, we might want to only accept investments that have an IRR less than our cost of capital, right? So let's look at an example. Suppose Smart Tech Appliances offers extended warranties to customers who buy dishwashers. The warranties cost $150. They guarantee the customer will pay no repair costs if anything goes wrong with the dishwasher for 2 years. SmartTech CFO Andy Stizer estimates that on average the company will incur costs of $50 and $175 in the first and second year, respectively, for each warranty sold. So he calculated the warranty IRR as 26%, right? Their cost of capital is 10%, so with an IRR of 26%, the warranty program seems like a good idea. But he's suspicious because over 2 years, the outflow cash is a lot greater than that 150 warranty cost. So we're going to calculate that NPV and figure that out. So he does this with the 150, that's what the cost is, so that's an inflow. And then we are taking away, which is why it's negative 50 over 1.1 minus 175 over 1.1 to the second, right? So our NPV is actually negative $40. So offering warranties on these terms is a bad investment and it destroys the value. The IRR rule here, accept investments if the IRR is greater than 10%, sends the wrong signal here, right? But only because the cash inflows occur first and the cash outflows afterwards. So an investment is like borrowing money, where the decision rule must flip. So they need to reject this investment because the 26% IRR is essentially a cost that the firm's paying. And that cost is above the cost of other funds available. And it's above that 10%, right? We could have multiple IRRs, more than one IRR resulting from a capital budgeting project with a mixture of cash inflows and outflows over time. The maximum number of IRRs for a project is equal to the number of sign changes in their cash flows. Okay, so let's look at an example here. Consider an investment of the cash flow stream shown below. We begin with a cash outflow, we produce an inflow, but then we require an additional expenditure where the investment life comes to an end. So let's solve for the IRR. Because this equation raises the IRR term to the second power, it could potentially have two unique situations, right? There are two values that solve this equation, 9.39 and 57.28. At each of those discount rates, the NPV is zero. So applying the IRR decision rule here is nearly impossible. Suppose the cost of capital is 15%. Is the project a bad one because the IRR of 9.39 is less than 15%, or a good one because that is, 57.28 is greater than 15%? So we could take a look at 10.5 figure. We're going to look at that. It's an NPV profile for this investment specifically that shows that the NPV is negative at discount rates below that 9.39 and above 57.28. But otherwise, it's positive. So if the relevant cost of capital is 15%, the investment is a good one. In a case like this, the IRR does not reliably signal whether that it's a good or a bad investment. But given the cost of capital, the merits of the project are clear from the NPV. So let's take a look at this. So we see IRR1 and IRR2. So anything between 9.39 and 57.28 is acceptable, right? That's a good investment. But anything on the opposite spectrums is one that we want to avoid. We can look at modifying our IRR. For projects with a lot of IRRs, an alternative method is called the modified internal rate of return, or the MIR. It can provide clarity on investment's merit, right? It transforms a project's cash flows by discounting all negative cash flows to the beginning of the project's life and compounding all those positive cash flows to the end of the project's life using the cost of capital. This results in a single cash outflow at the beginning and a single cash inflow at the end, guaranteeing a single IRR. So the MIR is the growth rate or interest rate that equates the present value of a project's cash outflows to the future value of their inflows. So this is the equation for a project that spans n years. So MIR is equal to for future cash of inflows at time n divided by present value of cash outflows at time 0. You're going to raise that to the 1 divided by the n time n minus 1. So let's take a look at the example. So we're going to find MIR. The cost of capital in the previous example was 15%. In this problem, there's just one cash inflow of the 248 in year 1. So we're going to compound that to find the future value in year 2. So again, that 15% growth rate. So 248 times 1.15 gets us 285.20. That's the future value at the end of the project's life of all the cash inflows. Now calculate the present value at time 0 of the project's cash outflows. So two cash outflows, negative 93 up front and negative 160 in year 2. So the present value of those cash outflows is 213.98, which is negative 93 plus the negative 160 divided by 1.3225. With a single present value at time 0 and a single future value at time 2, the MIR is going to equal 15.5%. So that's greater than the cost of capital of 15%. So the project is actually worth undertaking. Although the MIR approach provides a solution to problems of multiple IRRs, the solution remains controversial because it produces different results. There's a lot of ways to calculate MIR. There's not a clear approach that's better than the other. It can be difficult to interpret. So it requires compounding and discounting, or maybe even both cash flows at the cost of capital. If an analysis is doing these calculations anyways, why not just calculate the NPV, right? So what's better? A theoretical view will tell you that the NPV is the better approach to capital budgeting for several reasons, because it measures how much wealth a project creates or maybe even destroys if it's negative for our shareholders. It's our gold standard for evaluating our investment opportunities. For an investment project, the NPV calculation always provides a single answer, but sometimes the IRR calculation has more than one solution, which we saw. So it makes implementing the accept or reject decision problematic. Practically, despite the advantages of the NPV, financial managers are using the IRR approach just as often, or maybe even more than the NPV method. The intuitive appeal of the IRR technique is due to the general disposition of business people to think in terms of rates of return rather than actual dollar returns. So firms that analyze investments using the IRR technique often calculate the NPVs as well. So theoretical shortcomings at the IRR most likely don't lead to managers making those suboptimal decisions. Researchers surveyed CFOs about what methods they use to evaluate their capital investment projects. One interesting finding was that a lot of companies use more than just one of the approaches that we've covered so far in this chapter. The most popular approaches by far were the IRR and then PV, used about 76 and 75%. Those techniques enjoy wider use in larger firms, with the payback approach more common in smaller firms. So what did we talk about this chapter? We looked at the key elements of what budgeting capital process looks like and how managers use a lot of techniques to make investment decisions to maximize those firms' values. Identify those wealth creating projects, and we want to prioritize them, right? We also looked at calculating the payback period, the time recovered to recover that initial investment, how we give preference to investments with those shorter payback periods. It's easy to calculate, has a lot of intuitive appeal, right? It's the least crude way of adjusting for that time value of money and project risks, but it lacks that connection to that wealth maximization goal that we want. Then we looked at the NPV and the EVA, the economic value added and the net present value, right? So the NPV measures the wealth generated by a project. It creates value, while the negative NPV destroys value, right? The EVA does the same thing that the NPV does. It calculates the project's net cash flows, but it subtracts out those cash flows that are designed to capture that return that those investors want from that project. So the EVA calculation asks whether the project generates positive cash flows above and beyond what the investors are demand. If so, that project is worth undertaking. We looked at calculating the IRR, the discount rate that equates that present value of the outflows to the present value of its inflows. It's an estimate of the rate of return that an investment earns over its life, right? Over its life. By accepting only those projects with IRRs in excess of that cost of capital, we need to enhance our market value and the wealth of our owners, right? So both the NPV and IRR yield those same accept reject decisions, but they may provide those conflicting rankings between projects. We also looked at using net present value profiles to compare the NPV and IRR techniques by looking at a graphical situation for various discount rates. So the NPV profile is prepared to develop that number of discount rate net present value coordinates, right? Including those discount rates of 0%, the cost of capital, and then finally IRR for each project. And then it plots them on the axes, right? And then we looked at the NPV and the IRR and conflicting rankings and the strength of each of those approaches. So there's a lot of differences in the magnitude, the timing of those cash flows. Theoretically speaking, the NPV approach is superior because it's going to correctly identify those investments that create the most wealth for our investors. But a lot of firms are using the IRR approach because it's very intuitive, it's easy for managers to understand and communicate to others. I know we talked a lot this chapter about NPV, EVA, and IRR. If you guys have any questions, feel free to hop on one of the Zoom office hours or send me a quick email while you're working on your homework and getting through things, maybe one of the cases that you might have a question on. So feel free to reach out. I am here to help you. If you have any questions, again, just please reach out. Thanks, guys.